Well, good morning, everyone. My name is Marc Saurborn. I'm a CEO and CIO of Dividend Assets Capital, and I'm very proud to introduce Don Luskin, who's our guest today for this fireside chat. For a man who doesn't need much of an introduction, during Don's esteemed 45-year career as an entrepreneur, an investment strategist, investor, and a commentator. Um, Don is prior to founding TrendMacro, Don was vice chairman and chief investment officer of Barclays Global Investments and Wells Fargo Investment Advisors. During his long tenure career, he has a number of notable milestones. One of which we talked about was the target date funds and some of the sector and active ETFs. So we can thank Don for his genius in doing that. Don was also, I think, one of the first people to trade an option in an exchange. So way back in the day. So I wanted to welcome Don and is our keynote sort of commentator here, frequent contributor to both Fox Business as well as the Wall Street Journal and op-ed pieces. So without further ado, I'd like to introduce Don Luskin, Chief Investment Officer at TrendMacro.
Thanks, Mark. What a generous introduction. All those things that you say I did, what does that really prove? That I'm old.
You're very tenured, very tenured.
There you go.
And much like our prior interactions, we're going to keep this open. We have a number of questions to ask Don today, a number of subjects. We also had some questions from our audience, and we're going to try to cover as much real estate as we can during the time that we have. But we're also able to submit questions during this webinar as well, and they're anonymous, so we won't call out anybody. There's no dumb questions. This is an open format for the benefit of our clients and COIs. So please feel free to continue to add additional questions if time permits. So I guess I wanted to get started with you, Don, talking a little bit about the economic outlook. And so where would you currently carry? It's a little bit interesting, the state of the U.S. economy and where we are now. There's been clearly a lot of things changing more recently that may have colored that outlook both positively and negatively. But where do you sort of see we are in a sort of the business cycle, and what's your outlook overall on the U.S. economy?
We're in a boom. We went through a very difficult period after Lehman Brothers and Fannie and Freddie failed in 2008. We had the banking crisis that stretched through 2009. That put the United States economy into an era that economists called secular stagnation. It lasted for 15 years. And weirdly enough, the event that occurred right at the end of that era of secular stagnation, where we had pretty low growth, was the pandemic. And the pandemic was just an outright depression. That was a true economic crisis and human crisis. It was very brief. We came out of it very quickly. We came out of it stronger. And ever since then, we've been in a boom. I think that boom is in part because of the terrible lessons that we learned during the pandemic about how to find new ways to be productive, how to do more with less. During 3 to 6 months, when you had to do with less, we really discovered superpowers among ourselves, and we're exercising one of them right now. Look, we're all together meeting virtually. That's so efficient. That's so productive, and we can thank the pandemic for that. We all learned about Zoom. Zoom was around before the pandemic. We just didn't know it. We just didn't know to use it. So here we are. So we've been in a productivity boom for 6 years, ever since the pandemic, because even when the economy opened back up, we retained those lessons. And then in the middle of that 6-year period since the pandemic, AI came along. That's a whole new productivity revolution. That's the kind of productivity revolution that America has every generation or so. You take it all the way back to the railroads, to electrification, to the automobile, to chemical processing, to jet aircraft flight, to the microchip that led to the PC revolution, the internet, and now artificial intelligence. So this is a technology revolution, which is to say it's an American revolution. We're in a boom. like America usually is.
Yeah, and you bring up a good point, Don, about, this is, we tend to be a little bit myopic as American citizens, but this is a global phenomenon, correct? So this is something that's going to roll across the entire globe.
Yeah.
And the US is trying to position itself as, as the free market society, a
Yes.
democratic society
May,
relative
may I,
to
may
other.
I jump, may I jump in on that point? With AI in particular, the United States, it just happens to be the location at which all of the great breakthroughs happened that made that possible. But on the other hand, the thing that made those breakthroughs possible, those were intellectual breakthroughs, scientific breakthroughs, computer programming breakthroughs. But they would not have been possible without the unbelievably complex and precise manufacturing capabilities in Asia, in Taiwan, that make it possible to produce all those NVIDIA chips that make it possible to produce all that AI. So this is, in fact, a global partnership in producing AI. But the thing I want to focus everybody on is the reason AI is so valuable is not just that it'll make fortunes for NVIDIA and ChatGPT and Elon Musk and all those, is that there are 8 billion people on Earth who will all, to some extent, be lifted up by AI. Because the one thing in this world that there's always a shortage of, that there'll never be a surplus of, wait for it, it's intelligence. And for the first time, we've figured out a way to just make more of it. You can't believe how great this is going to be. And it's going to be great everywhere in the world, rich and poor.
Yeah, I always joke, my smartphone is smarter than I am, but that's going to be even more relevant going forward for everybody. And it's going
Yeah,
to
but
be,
Mark, your smartphone makes you smarter. You're in a partnership with your smartphone. It's not a competition.
Mhm.
And that's the secret here.
Well, that's important. And kind of shifting, kind of related, talk about productivity innovation, which you've addressed. Now that we're sort of past this, you know, rather notable SpaceX IPO, we certainly had some questions on what do you think, how that's going to impact the market. Just that I would say it's a watershed moment, but it's an important milestone. And then, kind of talking about more about the AI generation and separating the kind of the facts from the hype, and then wrapping that into, say, future productivity growth, which,
Right.
we can discuss later.
Yep. Well, let's talk about some of that productivity growth. Um, I'm I'm a user of AI myself. I got it, on November 30th, 2022, when ChatGPT was first opened up for the public to play with. I was there the first day, and it's just been amazing how it's all grown up in just 3.5 years. There are competitors now, and the sophistication of it and what you can do with it is just vastly improved in just 3.5 years. I use it to write computer programming code that I use in my business. It's a real advantage to me to be able to get computer code and Excel spreadsheets codes made quickly, cheaply, so that I can get the results I need and share them with my clients like you, Mark, sooner rather than later. The definition of productivity is how much you can produce per unit of time. And for me, if I can get my computer code faster, that means I can produce more results for you in less time. That is simply the definition of productivity. So I think this is the real thing. I also use it for research. It wasn't very good at this at the beginning, but I can now ask it questions about, I don't know, market history or we've in this war we've been in and with Iran. There have been all kinds of like geopolitical history questions that I've been able to ask it, and you learn a lot. You learn it quickly, and that's where productivity comes from. Now, productivity means doing more with less. So you immediately leap to the fear that people will lose their jobs because when machines start doing things for you, like when I don't know, the steam engine was introduced, uh, I guess people with shovels maybe were put out of work. So now, given how I say I'm using it, are computer programmers being put out of work? Are researchers being put out of work? Possibly. It is the case that the number of computer programmers in the United States has not grown at all in the 3 years that AI has been on the scene. In fact, it's shrunk by about 100,000. It's gone from 2.2 million to 2.1 million. And number of computer programmers working in America, that's a class of payrolls that's never gone down until now, but it did.
Yeah.
But we can measure the value of the programming that gets created in the United States. And during the time that the number of computer programmers has fallen about 5%, the value of programming has risen by 50%.
Mm.
So somebody got a lot more programming. Somebody was able to grow their business. Somebody with that larger business was able to hire somebody to do something. So you can be cynical about it. You can imagine a CEO saying, well, my computer programmers are now twice as productive because they can use AI. So I'm going to fire half of them and I'll have the same amount of production. You could say that if you're a loser. What do you say if you're a winner? If you're a pro-growth CEO in a competitive world who wants to be a winner, you say, wait, my computer programmers are now twice as productive. I need 2 times as many of them because I don't want to just hire people. I want to hire superheroes. I want to hire people with superpowers. And these guys just got superpowers because they're partnered with AI, like I was saying you should partner with your cell phone. So this is how capitalism works. There are stupid companies that look at opportunities to save a nickel and save a dime here. There are smart companies that look to see what it is that augments human capital and run with it.
Yeah, I mean, I think that's an important point because, you know, we talked about the number of programmers, but now with AI and especially agentic, everyone can be a computer programmer. So we can
Right.
automate those manual tasks that were
Yeah.
taking time. We can automate them, make them more accurate, more efficient. So
Yeah.
it's starting in the software world right now, but it's going to bleed over, I think, into the everyday day-to-day world.
Yes, it
And
will.
does that necessarily supplant, anybody? No, it just makes us, like to your point, more productive, more efficient.
But
And
throughout human history, there have been advances that make our lives more comfortable and extend our lives, and that's changed the patterns of living and working. At the turn of the century, when the 1800s became the 1900s, 63% of Americans worked on farms.
Yep.
You know how many work on farms now? 2%.
Yeah.
And
Yep.
yet we're feeding 5 times as many people,
Yep.
and those people had to find something else to do besides farming. And it worked out pretty well, didn't it?
Yeah, yes, it did. Farming is quite a difficult difficult job title.
Hey man, it sure was in 1900.
Yes, and there wasn't a cataclysmic, like again, we were able to move those people, shift them into more productive roles over time.
Yep.
And therein lies the opportunity. I mean, as we move forward as society, we're going to be more productive. So one would be able to logically extend from what you believe or your commentary that we're just getting started on this next productivity wave, and as we sort of hockey stick up and to the right. We're going to find other uses for this, whether it's increasing, our lifespans or improving the overall quality of life of everybody. To your point, that this is going to be transformational for lifting everybody, maybe even reducing poverty, abject poverty, because you need access to these tools, making humans more efficient. So that's very exciting. But we kind of shift. We talk about productivity. Our company's productivity is reflected in their operating margins. And one of the things that we talked about, there were some questions about are the markets overvalued right now? All-time highs. Are you worried about these? Are we getting to bubble multiples on some of these things? And we can have a discussion about that. But what we're seeing in our companies is these, the operating margins are expanding. I think you had a slide one of your publications talked about the acceleration of profit growth. And short term, the market's a voting machine. Long term, it's a weighing machine. And that weight ballast is earnings growth. And so we're seeing that. If historically the S&P 500 was growing, sort of 6 to 8%, we're at 22%.
Yeah.
And there doesn't seem to be a deceleration occurring, and that's,
Yeah.
leading to this market growth. But
Yeah.
kind of
Man,
talk about that
Mark,
intersection.
the only time you see earnings growth like we're experiencing now is when you've had a long, horrible recession and you've just had like a year and a half of losses,
Yep.
and all of a sudden any little growth just looks
Yeah, it looks like,
fantastic because you
yeah,
have a zero
awesome.
base.
Yeah.
Well, we're 6 years into this business cycle, and we're having a better earnings liftoff than you have after a normal recession. This is this is really, really good. And, sure, stocks are at all-time highs. They actually are most of the time. Did you know that? Right. I mean, just look at the chart. They generally go up. That means they're mostly at all-time highs. Uh, Forward earnings multiples are actually not at all-time highs. They were, far higher in 1999 and 2000,
Yep.
and we paid a price for that. They've been about where they are now, which seems high on in the grand scheme of things. I suppose it is. Warren Buffett and Graham and Dodd wouldn't exactly be snapping them up here. But on the other hand, these multiples that just seem so bubblicious by some ways of thinking about it, we've been at these multiples now for 4 years. When you're going to have a bubble, it's just kind of this hyperbolic journey to some crazy zenith where every shoeshine boy is talking about stocks and quits his job. No, I mean, I remember 1999. I remember 2000. This is nothing like that. I wish.
Yeah. Yeah, we were talking a little bit about that before we got started on this webinar about, kind of the parallels, and, history doesn't repeat itself, but it can rhyme. And, but we're not seeing that right now because of the earnings growth and productivity expansion. And it doesn't seem to be, there doesn't seem to be an end to it right now. So this is not like a short-term issue. This is definitely a structural, long-term issue. And we haven't even started to see to your point, the real productivity gains, because we're just getting started. I mean, geez, from a AI integration standpoint, most companies are just kind of, playing around and trying to figure out, where the baseline is. They haven't even been able to really implement it. And then from a long-term plan, like they know they need to integrate it, but they don't know how it's going to really manifest itself.
Yeah.
Because the capabilities keep improving, like the capabilities keep improving. So it's very difficult to kind of model that out as an operating company.
And in so many companies, they're always this kind of guy who says, "Oh, I don't know, it's risky. We have to take this slow."
Yeah.
Those are words that Elon Musk never uses.
No, definitely not. Definitely not. Not even when he's sleeping. The other thing is that, we look at, when you think you're a company, you're making an investment, you're putting capital to work, you're trying to come up with the net present value, you're using some sort of hurdle rate, and you're trying to make sure it's positive. And the thing is that these investments, they cash flow from day one, like virtually from day one, like they're producing free cash flow. And that's what makes it so compelling. You don't have to say, hey, apart from the data integrators and the AI data centers, yes, that is a longer term CapEx cycle, and they have to get a return on that. But as a company that's implementing AI, you're sort of seeing those benefits day one. That's what makes it so compelling for a company to start integrating that, because you're saving cash flow almost immediately. It's kind of what we're seeing in our companies. I mean, it's you can really see the manifestation. I think that they're even surprised with the productivity enhancement they're seeing. And we think it's going to continue. It seems to me like you're in the same school of thought on that.
Very much so. You used a key word there, and I want to make sure everybody appreciates that you used it. You used the word surprise. The thing that keeps a rip-roaring bull market going is positive surprises. If there are no surprises, then what's going to change prices? There's no new information. So the thing that is fueling this is that we raise the bar of our expectations, and then it clears the bar. It surprises us. At some point, it just gets hard to do that for another quarter, right? So, I don't see the worst risk here, that we're some kind of speculative bubble that's going to pop, or there's going to turn out to be some fraud, or, we're a war or something like that. I just think there will come a day when we just have a "what have you done for me lately" problem, or "what do you do for non-core?"
Mhm.
And that's fine. That's fine. I mean, these things need to take a recess and then go back to class.
But that's years in the future. It doesn't seem like it's gonna be next quarter or, even next year right now, at least what
Doesn't
we're
seem like
seeing.
it.
So, that's always a good.
Yeah. Well,
Maybe,
let's just be alert to it.
yeah. And we are mindful. We're monitoring our companies, every day, but certainly quarterly and asking those questions. So, we are, trying to, acknowledge that and ask those tough questions. But right now, to your point though, I just feel like, our commentary from our company discussions are like, yeah, we're seeing this productivity enhancement. We're excited about it. If we were thinking about it, our early sort of test cases have been very positive, so that we're going to be start implementing that across the board. And I think that more and more companies are doing that. And obviously the technology savvy companies are already doing this, but even they are getting efficiencies, which is really interesting. Like the Mag 7, like they've been implementing this for a very long time already. They've been leaning into this for some time, and even they are surprised with the level of productivity they're getting. And I think that overall companies are going to start seeing that, and individual consumers as we go forward. So it's going to be interesting. It's going to be a wild ride to see how this all transforms, and there's going to be puts and takes. But I don't think the endpoint is going to be defined. I think it's going to keep going and going for quite some time. So good commentary. Um, Before we sort of shift into interest rates and the Fed and our new chairman, time to talk about the labor market dynamics, because we touched on it a little bit here with the productivity. And there was a lot of fears that, oh my gosh, it's going to create, I've spoken to people about this before, massive unemployment, and how it's, there's going to be, we're going to have 10% unemployment or 15% unemployment, and we're going to have minimum basic income, and all these things are going to have to happen for us to really embrace this productivity enhancement. And I think you touched on this and where we are right now, from the labor cycle, and your expectations are, are what, based upon what you see.
Well, what we're seeing in the labor cycle is really nothing but just the very logical operation of demographics. We have we've gone in the last year under a new president to a very different immigration policy. And there was a tremendous amount of jobs growth during the Biden presidency, first because he presided over the return from the COVID lockdowns, which brought, there was one jobs report where I think it was, like 1 million payrolls gained, right? Well, that wasn't because like 1 million people got jobs exactly. That's just because they'd all gotten fired 3 months earlier, and then they could take their masks off and come back to work. But then, under President Biden, there were, even after the reopening was quite complete, there were a couple of years of just spectacular jobs reports because there was so much immigration. And we can have all kinds of different conversations about immigration, good or bad. It has good things about it and has bad things about it. But one of the things we do know about this particular immigration episode is that just in terms of the number of people as a share of the population at the starting point, it was the second largest immigration wave in history. The first largest was, it was a 3-year period. The first largest was 1904 to 1907, which was the Ellis Island, Godfather Part 2 immigration era. This was almost at that level. And someday there'll be movies made about this. Now, Trump becomes president, and that just hits an absolute hard stop. And there was a lot of, at least attempted enforcement about illegals. And to my knowledge, I don't believe there has been a measurable, important amount of forced deportation, but I think there's been a lot of self-deportation of people who came here for opportunities, legal and illegal, and they just said, well, the climate just changed. This is a bad idea. I'm going home. And it's very hard to get into this country. You need coyotes and all kinds of subterfuges. Real easy to get out. Nobody checks on the way out. So we had a year when there was basically no jobs growth because of that. So that seems to have been metabolized. So the jobs growth that we're seeing now is pretty much just what you would expect without any immigration. And what would you expect? Well, you become eligible to work legally in this country as a citizen if you turn 16. You have to, so that's at the beginning of the demographic cycle, and at the other end of the demographic cycle, the thing you have to do to be able to work is to not die. So the net of the number of people who turn 16 minus the number of people who die is about 75, 80,000 a month. So that is the dial tone. That's what you should just expect, all else equal, from a jobs report on the first Friday of every month. So that's great. That's just, what it is. Now, 25 years ago, say in the year 2000, the largest section of the American population was that group from 40 to 45. So that was 25 years ago. So they're now 65 to 70. So most of them are still alive, but they're beginning to retire. So that was the demographic headwind that we faced for 25 years. The baby boomers were aging out. It's just the opposite now. The largest age cohorts in the US are the youngest, 16 to 20, 20 to 25. So we have a demographic dividend that's going to be rolling through the economy. So that's what's moving this. That's what's moving this. It's just the numbers. It's just demography. It's just biology.
That's so, I would hope over time we have a more reasonable immigration policy. We don't, we're definitely going to need to replace those boomers who retire, or, and even with the enhanced productivity, we would hope we have more rational
Well,
policy.
man, all I can say is hope springs eternal, but America has done many things right during its wonderful 250 years. Getting smart about immigration, we've never ever done that, ever. Now, every once in a while, we let people in like Elon Musk. Every
That's
once in a
right.
while, we let
That's
people
right.
in like Steve Jobs' parents, came from Syria.
Yep.
Okay,
Yeah.
it's a cool thing to bring in people because they change the world.
Yep. Um, Kind of shifting a little bit, we were talking about this previously, about the market was sort of fixated on one price prior to the SpaceX IPO, and that was price of oil. Kind of talk about where you see, we have hopefully peace in the Middle East, hopefully that sticks. But your expectations now, when we look out the next couple of years, both domestically and then globally, relative to, look at commodity prices in general, and then just to see how that might impact inflation or some of the other growth opportunities out there.
Okay. Um, Absent supply shocks like a war that closes down the Strait of Hormuz or some other choke point, or like the sanctions that were put on Russian oil when they invaded Ukraine in February of 2022. Those were geopolitical shocks that artificially tightened the oil market for a while. But we believe that a barrel of oil just has a kind of base price it's going to be in a range. There's no one single price, but for us that range is 60 to 80, and we began the year at 60, and right now we're at 80. We went to 126 in the meantime.
Yep. Yep.
But hey, I'm going to take a little victory lap here. When we were at 126, we said we're going back to 80 like right away. And we didn't say that because we have some inside information about what kind of negotiations are going to happen between the United States, Israel, and Iran. Not at all. We have the same information you all have, which is you can all just look at the futures market. And when oil was at 126, the futures market was telling you that it was going to be 80 today.
Yep.
So the really smart people, I mean, oil gets to 126 because there are desperate people and the Strait of Hormuz is closed, and there's some importer in Japan who just absolutely had to have a barrel of oil. But when the futures markets are pricing transactions out 3 months, 6 months, 6 years, there's no urgency there. That's just people being intelligent with each other. And the only people who trade oil with each other years in advance are the people who actually know what's going on. Like, I don't know, this is where Exxon trades with American Airlines.
Yeah.
So we didn't have any unique insight. We just saw what you could see. But, oh no, the smartest people in the world were saying, this is the worst energy crisis, and it's worse than all the others put together. This is World War III. There were serious people saying both those things
Yeah.
every day. Oil will go to 250.
Yeah, 250. I saw that. I was like, okay,
Oh
this
my
must be
God.
the top.
Okay.
Yeah,
So, there was some guy who was long, who has a friend at
yeah.
CNBC, who could get that headline out.
Chocolate book,
I mean,
chocolate book. We're probably quadruple levered. It's
right.
funny. It's a long time energy analyst and investor. Doing this a long time. I learned early in my career. Somebody sat me down and said, "Hey, you know what the cure for high energy prices are, don't you?" The answer is high energy prices because because it is a commodity and it's
Yeah.
supply and demand
Yeah.
and so
Yeah.
we're kind of seeing that today.
Yeah.
Reflecting the quick drawdown, even though I think global inventory is probably a little bit light, just given people have been drawing on reserves. U.S. has been pulling on the SPR. I'm sure other major developed countries are doing what they can there. So,
Right.
but still, yet we've had that real sharp price reaction, just to the announcement, not even
Yeah.
to the actual physical volume flow
Yeah.
through the strait. So
Well, see,
interesting.
this is a perfect example of what I meant when I say markets are moved by surprises. But so, our petroleum reserve is now down to levels we haven't seen in 40 years. But on the other hand, unlike 40 years ago, we are way more than energy independent. You could make a very rational argument that we don't need a strategic petroleum reserve. We are not only completely petroleum independent for our own needs, we are not, we're also a very large exporter. So a lot of the drawdown of the Strategic Petroleum Reserve in the last couple of months has been so we could increase our exports.
Yeah.
So we've been sending our oil to places in Asia that are much more impacted by the closure of the strait. And that's great, man. We're just an energy powerhouse. Now, who you don't want to be if the Strait of Hormuz was, say, to permanently close, you do not want to be India, Japan, South Korea, or China, right? Because they are completely dependent on that. But you know what? They know that. So they have strategic petroleum reserves vastly larger than ours. Like from today, you could shut the Strait of Hormuz down. China would have a 200-day runway from its SPR. So this was never the drop dead existential crisis that the howlers on CNBC wanted you to think.
Yeah, that's a really good point. And the other thing is that, again, we're a major supplier of distillates, not just crude and also natural
Oh
gas
yeah,
liquids.
man.
We're like the world's largest exporter of propane now, not
Well,
just natural gas.
we are the colossus of world natural gas. We produce more, consume more, export more than anybody else by factors. And so, in case there's anyone in the audience who doesn't know what this means, you use that word distillate. When you're producing all that natural gas, a nice byproduct of that are these liquids that come out either or at the wellhead and or at the point of refining, and that is roughly substitutable for a barrel of oil.
Yep.
It's a barrel of those distillates is under certain circumstances, it's just kind of like a barrel of gasoline. You could run your car on it. I wouldn't recommend it, but it would work for a while. So we produce more than 13 million barrels a day of crude. We produce more than 7 million barrels a day of these distillates. You put those two together, and that alone, without considering ethanol and refinery gains and all the other ways we get oil, those two sources alone, the crude and the distillates, that meets our consumption needs of 20.9 million barrels a day.
Well within. The other thing is that reflects balance of trade. Also, we're not importing that. So, as we're exporting, we're collecting hard currency on those exports, and that's benefiting the U.S. economy greatly.
In case anybody on this call doesn't know that, I am speaking to you from Dallas, Texas. So we are incredibly aware of what you just said.
So as far as this being a geopolitical issue, we're kind of beyond that, and we're just looking at the forward curve to show that the markets, the physical markets, not the short-term trading markets, don't seem to be very worried about this and figure that we're going to be reverting back to normal fairly quickly.
Yeah. And in the longer run, a shocking experience like this is it's a necessary lesson. So the Persian Gulf oil producers that came through this intact would be like a Saudi Arabia that isn't particularly dependent on the Strait of Hormuz. I mean, they produce and export something like 9 million barrels a day, and something like seven of that can be put on a pipeline from the Persian Gulf and piped all the way from east to west across Saudi Arabia to the Red Sea at the port of Yanbu. So they don't need the Strait of Hormuz at all. Half of Iraq's production can go on pipelines through Turkey. Some of the United Arab Emirates production can go through pipeline across Oman and completely avoid the strait. So about half, maybe 5/8 of the volumes that were going through the strait just went somewhere else when the Iranians closed the strait. Now, there are some countries that don't have those facilities. Qatar, Kuwait, Bahrain, they'll have those facilities in 5 years. I think they heard the alarm clock here.
Yeah, there's a little bit of impetus. It's interesting, like you said. It's like kind of use Jeff Goldblum quote. Nature will find a way. Human beings will find a way around this. It just takes a little bit of capital and some time. But everything's elastic in the long run. We talked about it, and that's the capital as well as physical commodities. So that's pretty interesting. So I go into shifting into one of your former friends, colleagues, Kevin Warsh, his tenure now at the Fed. And I'm kind of looking at that from a broader sort of monetary policy in the U.S. and talking about what changes you expect as he takes over leadership of the Fed and what that could mean for the markets going forward.
He's pretty transparent about his agenda. He like me, writes for the editorial page of the Wall Street Journal and has been doing so for quite a while. He believes that the Fed is an arrogant institution that's been captured by groupthink. He believes that they're obsessed with old-fashioned, highly complex economic models that never produce good forecasts because they're based on garbage. And he's completely right. One of the things for instance, a classic, you hear Fed officials say all the time. They were saying this, 3 or 4 years ago when we were having just those blockbuster jobs reports, very low unemployment rate in the 3%. They were saying, oh, well, a low unemployment rate creates inflation because of a wage price spiral, right? So, that comes from the 1950s. There was an academic paper by Mr. Phillips, and that relationship between the unemployment rate and future inflation is called the Phillips curve. And every central banker in the world and every PhD economist in the world believes absolutely that that's what happens. There's just one problem. It's really easy to get a 100-year history of the unemployment rate. It's really easy to get a 100-year history of inflation. Those two things have absolutely no correlation with each other. So you can't get a PhD in economics from MIT without pretending that there is that relationship. And they set monetary policy based on that relationship. And so, Kevin, he comes in and says, what? Why? I've just spent the last 15 years trading with Stanley Druckenmiller, and we don't make hundreds of millions of dollars together by trading on things that aren't true. So why do I need 1,200 economists throughout the Federal Reserve System? If I want to have incorrect forecasts, I think maybe I just need 3 or 4. So, there could be a Doge the Fed thing here where, he could come in like a new CEO, a new broom, and really sweep some of these cobwebs out. He has the unilateral authority as the CEO of the Fed by statute to do that. Now, there's some things he can't do. There's some things that require a committee vote. He cannot change interest rates unilaterally. He cannot shrink or increase the balance sheet unilaterally. But he can change the tone. He can change the research staff. He can do lots of things. He has said that he believes that the Fed, being as stupid as it is, talks too much. That maybe if you have nothing but inaccurate forecasts, maybe you just shut up. Maybe you shouldn't give speeches all the time. Maybe we could go back to the Greenspan and Bernanke and Yellen eras when we only had well, actually, I should say, Greenspan never had press conferences. That started under Bernanke, and Yellen continued it. They used to have press conferences after the FOMC, but then they'd skip one in between. So Jay Powell shows up, and who knows if he thought it was a good idea to have more communication, a press conference every meeting, or maybe he just liked to be in front of the camera, or maybe both. I don't know, but there's just no value added here. So, I think Kevin he cannot command his fellow governors on the board or the regional presidents of the regional Federal Reserve banks to not give speeches, but he could certainly abolish traditions like press conference every time. He could abolish the tradition of having those dots that everybody upsets at.
Yes, dot expectations. Yep.
So how much of all that he will do, I don't know. I do know that in terms of real substance, the thing that is most important to him is to shrink the Fed's balance sheet. He thinks that is a sign of mission creep, of corruption, of lack of independence. When the Fed owns $2 trillion of mortgage-backed securities, how can people say that Donald Trump is trying to take away the Fed's independence? The Fed took away its own independence when it started subsidizing housing in this country. The Fed owns $4 trillion of Treasury bonds. When did the Fed ever get in the business of financing the U.S. government? So Kevin comes in wanting to shrink all that. A Trump nominee is coming in with the number one mission to make the Fed more independent, not less. Do you ever hear that? No, you hear a 180-degree opposite of that. So this will take time, it will take persuasion, it will take a vote, it'll take cooperation with Treasury, because all those assets that the Fed holds that it shouldn't are going to have to go back to the Treasury. There's actually a fairly simple way to do that, but it would require Treasury agreeing, and it would require the FOMC agreeing. So these are all things in the future. He has a wonderful opportunity. Now, just before I stop, I want to mention that I've known Kevin personally for 23 years. He is a fine man. He is walking into a lion's den. And the swamp, Washington, these institutions, they have a way of taking fine men like Kevin Warsh and chewing them up and spitting out their parts. So I do not envy him. Maybe he's a fine man, maybe he's not, but being a fine man isn't all that it takes to succeed. He's very smart. He has a very high emotional intelligence quotient. If anyone can do it, he can. But with the persecution of Jay Powell that Trump has undertaken over the last year with the Department of Justice investigations, it's poisoned the water for Kevin. He could have come into his first FOMC meeting, which is, in progress as we speak, and it'll conclude tomorrow afternoon. He could have come in with doors open to him. He has a wonderful reputation in Washington. He's a Bush guy, not a Trump guy. Privately, he doesn't think much of Trump, but he wants this job. He wants to serve his country. He thinks this is his highest calling. I think it is. He could have come in with an open door, and sadly, some mistakes were made, and doors are closed to him now. So this will take a little longer, and knives are out.
Well, hopefully he's up to the challenge, and I guess especially because he wants to make some significant changes to the way the Fed operates, and I would agree. It sort of shifted from its dual mandate. I think we all can agree. It's kind of gone off in a bunch of different directions. So, hopefully the bureaucrats in the Fed allow him to make these changes.
Yeah.
So that's why we wish him good luck and Godspeed, I think, in our last letter, because he's definitely going to need it. And honestly, whether Republican or Democrat or somewhere in between, you want him to be successful, right? We all benefit from it. So it's not it's not a one side or it's other. It's everybody wins or everybody loses.
Hey man, that by the way is a really important point you just made, but it generalizes. I'm more of a libertarian conservative, but when very liberal Joe Biden was president, I wanted him to succeed.
Of course.
And I hope liberals today want Trump to succeed. They may not want to see a Republican elected next time, but we got one now. So shouldn't our president always succeed? Shouldn't our Federal Reserve always succeed? Shouldn't our postman always succeed and get your mail to you? I mean, we want everybody to succeed.
Yeah. Yeah, I mean, we all benefit from that. You kind of brought up, you kind of opened the door, Don, for the next question, talking about, in case anybody's noticed, we are in a midterm election year. And, we typically tell our clients it really doesn't matter. It may matter short term, but, from a long-term standpoint, it really hasn't had much of a, markets have benefited under, regardless of political party, but anything different, especially you think about this upcoming election, given, where we are in the Congress and the Senate.
I mean, what you just said is true and wise and is the touchstone for this. I mean, just as a prediction, we're all imbued with this history that midterms tend to be some degree of a slaughter for whatever party's in the White House, and sometimes a very big one, like say in 1994 or in 2010. That is deep history that is completely irrelevant. It's not a guide anymore. Thanks to big data, and soon it'll get worse with artificial intelligence, gerrymandering has gotten so perfect that there are probably only 17 or 18 competitive districts out of 435 in the Congress. So there's just no such thing as a wave. Everybody's got a safe seat. So that doesn't mean that control couldn't change. Control has changed every 2 years by just one or two. That's happened for the last 3 cycles. That's our future. So this November, well, Republicans might hold the Congress, they might not. But whoever controls it, they're going to control it by 3 or 4. Now, the Democrats face a challenge, which is they come into this not in the majority. So they have to hang on to what they've got and take away something from the other team in order to win. So they're starting from that challenging position. It's like in a game of chess. They're playing black, not white. So they come in with that structural disadvantage. It's also a case that now that the redistricting wars are over, that's worked a little bit in the Republicans' favor by maybe 5 or 6 seats. So, Democrats could do it just by random drift, but all their toss-ups, all the competitive districts, they would have to hold every one of their own and flip 3/4 of the ones that the Republicans hold. Eminently doable, just not easy.
Yeah.
Now in the Senate, Democrats would have to flip 4 seats. And just look at the map. That's a real heavy lift. It's a real heavy lift. I don't think they'll do it. I feel pretty confident saying that I think the Republicans will hold on to the Senate, not because of the genius of their candidates or lack thereof on the other side. Just looking at the map. The House, coin flip.
Yeah, so even if we were to get a split, there, and then there's quote unquote gridlock, I mean, that's actually been quite a good positive backdrop for the for the financial markets.
Oh, yeah. Well, yeah, no question about that. In fact, I think my view, and I hear a lot of people say this, I agree with it, that today's economic and market environment feels a lot like the 90s.
Yeah.
That was an era of political gridlock. It was just beautiful.
Yeah. Especially we talked about all the things at this point with the productivity enhancement, the profit growth of U.S. companies. That could be like, I want to say it's an ideal scenario, but it actually could be more positive than negative. So I wanted to kind of relate that people always tend to, human nature being what it is, we tend to embrace the negatives more than the positive. But there is a glass half full scenario here, even if things don't go with everybody's political way that they hoped. And not to be, dissuade by making investments in the markets as a result of that. We get a lot of that, feedback, and that's fine. We appreciate, the client observations, but again, to your point, the facts belie that. The facts say either it's really good or it doesn't matter.
Yeah.
So that's a great backdrop.
It really is. It's stop and smell those roses, right? Because that just means that we live in this wonderfully free economy where government just doesn't have the power to terribly help it or terribly hurt it. That's great. We're on our own, and that's where I want to be.
Yeah. We had a couple of questions about deficit spending and the impact of that. I know you've commented on that particular topic several times. Maybe just kind of get an update where we're at on that, absent what we talked about, the Fed's balance sheet, and do you see it as a headwind or a tailwind or real risk factor, for the U.S. and global economies?
Uh, one can always wish we had less debt at the federal government level. A couple of reasons why you might wish that. One is because you wish we had a smaller government, and a smaller government would have more debt, would have less debt rather. Or another reason you might wish it is you don't particularly want a smaller government, but you just want the government we have to have less debt so that we can rack up more debt, so that there's more room. Because it isn't always the case, but often when people or governments borrow money, it's because they have some good idea of what to do with it, like buy a car that'll make them more productive, or buy a house that'll make them more productive and allow them to have a family. So there's nothing wrong with credit. It's just a tool, and you can say, well, a gun is just a tool. It can help you or it can hurt you. Electricity is just a tool. It really helps you. Do not put your finger in the socket, though. So that's all debt is. Now the typical debt phobic view is that the deficits in the United States are greater than the defense budget. Okay, well, whoever said that was the benchmark? And if that's how you feel about it, well, let's just spend more on defense. That way the deficit will be smaller. So I really want to resist sensationalistic slogans like that. I'd rather think about debts and deficits in the United States the way a banker would think about it. So our income in the United States is about $24 trillion a year. So that's basically our GDP. Our GDP is our income. Our debt service, the amount of interest we pay on the federal debt, it's about 3% of that. So think of that as a mortgage. You're going to a bank telling them you want to take out a mortgage on a house you're interested in buying. And they calculate what the payment will be every month. And you multiply that by 12. So that's your mortgage payment for the year. That's 3% of your income. You think you can afford that? Oh, yeah. Oh, yeah. You'll get that loan, right? But then the banker will say, well, wait a second. What's the total dollar value that you want to borrow, and what's your house worth? Did you have it appraised? Well, the total amount our federal government has borrowed it rounds to about $40 trillion. Well, what assets? What's the collateral on that? What's the house that collateralizes that? Well, the United States is like any other government. Our collateral, our ability to eventually repay our debt, is simply our ability to tax. That's all it is. And our ability to tax is directly connected with our ability to produce wealth to tax. So what would be a good proxy of the value of our ability to produce wealth in this country so that it can be taxed? Well, how about the market capitalization of the S&P 500? The market capitalization of any company is the present value of all its future after-tax earnings. So just look at all 500 companies. That's about $69 trillion. So we're borrowing $40 trillion to buy a house worth $69 trillion. Well, with that house is worth $69 trillion, maybe we should just put a 10% down payment on it, and instead of having $40 trillion in debt, have $60 trillion in debt. We'd still get that loan. So this is fine. Yeah. Do I love it? No. I told you before, I'm a libertarian. I want government to be smaller. I want our debt to be smaller. I want everything to be smaller. But there's no crisis here. Not at all. And if you think there is, well, you're entitled to your view, but Mr. Market sure doesn't think there's a crisis. You name one market, bond yields, tip spreads, credit default spreads, any market-based consensus indicator, not the slightest hint that there's any kind of credit crisis happening in this country.
Yeah, we're kind of against the top of the hour, but I wanted to ask one more question in closing. Talk about we're a little over a year since Tariff Liberation Day, and there's been a lot of back and forth, and you've had some great observations about it. Where do we sit now? And it's kind of faded into the backdrop, but it's still there. Where do you think we are in that continuum, given the politics and some of the other things? And I know they are actively Trump administration is still actively trying to negotiate trade deals.
Yeah.
Where do we sit in that, and what do you think
Right.
the
Well,
impact?
from my standpoint, Liberation Day was February 27th when the Supreme Court struck down the IEEPA tariffs. Um, the they're in the process of being refunded. It's about 165 billion in total refunds, and you'll get those refunds if you're Walmart, and you'll get those refunds if you're my wife, who had to pay a tariff of $3 to FedEx when she bought some lipstick from Paris. Temporary tariffs were put in place instead under another law, 10%. That law only allows the tariffs to go through July 2nd, so we're going to get another Liberation Day in a couple of weeks. Those tariffs have already been struck down by the Court for International Trade. That's under appeal. That is going to go to the Supreme Court. They will get struck down too. It sounds like I'm just being, ridiculously overconfident when I say that, but I want to credentialize myself. When the Liberation Day tariffs were first proposed, which was February the whole prior year, 2025, I said the morning the announcement came out that these tariffs would be struck down by the Supreme Court. Then when the case finally got to the Supreme Court, I worked with Judge Michael McConnell, who argued the case before the Supreme Court and provided him with all the economic arguments. I've seen this from the inside. I know exactly what's going on here. These tariffs are all going to get struck down. And with everyone that gets struck down, Trump is, like the Black Knight in Monty Python and the Holy Grail. He just keeps getting stabbed and limbs lopped off and,
Arm cut off.
Fight, you coward. So these.
Anyway, we're at the top of the hour. I wanted to thank Don for his insightful commentary. We always enjoy hosting him for our clients and COIs. And I want to thank everybody attending. I also wanted to close. Some may not realize this, but we have we're very proud to announce that we have a NASDAQ listed active ETF. It's the DAC 3D Dividend Growth ETF, ticker DVGR. And well, it's backwards. I'm going to hold it right side up, but I'm going to put on shameless plug here because we like to say we allow everyone to see their investments in 3D. So, here's a DVGR. We encourage you to take a look at it. It is based on our 3D dividend growth investment process. So we're very proud to have listed that on NASDAQ as a partner. So, but again, I wanted to thank Don and his team. We certainly appreciate their partnership with us, and we want to thank everybody today for attending. And with that, we'll end this webcast, and we look forward to the next interview with Don. So thank you very much.
Thanks, Mark. What a great host you are. Thank you.
Thank you. Take care, everybody.